We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Dave Kranzler from investmentresearchdynamics.com. He's also the author of the Mining Stock Journal and Short Sellers Journal. Dave, thanks for joining me today.
Thanks for having me on again, Tom. I always enjoy doing this show.
It's always a pleasure, and we always have a really good chat beforehand. And, today was no exception. But I wanted to start by talking a little bit about, where we are kind of at this point in the year and getting your perspective on basically heading into the summer being typically a slow time for the metals. We typically see, lighter volumes in both the metals and the miners. So with all the risks that we all basically understand at this moment, do you think this year could be any different?
I mean, it's starting off this month and really the end of May. We hit a all-time high, I think it was May 19th. And it's been downhill since, going into the Memorial Day weekend here, which is, a light week and often a down week for the precious metals. And then going into the summer so far, I mean, we're almost done with June, and gold's back down to testing 2,300 and testing, the 29 level. So, and they're both considerably lower from where they were, say, a month ago. Mm-hmm. So, I mean, part of the reason is that, as you kind of pointed out, things slow down. India kind of goes into a period of dormancy in June and July in terms of their gold importation. And it's not necessarily like that every year, but over the last 23 years that I've been doing this sector, in most years they don't really they get quiet in June and July for whatever reason. And then it's probably ahead of, they're just taking a break ahead of their largest seasonal buying period, which is September through the end of the year. So, and that also coincides over there with, the harvest period, because what happens is the farmers, once they get their crops sold, the money that they don't need to live on, they convert it into gold. So, and that adds to the demand from India. So, typically what happens is, at least from what I've observed, some people still think that, official gold price control or manipulation is conspiracy theory. It's not. It's conspiracy truth. It kind of makes it easier for the Western central banks and banks to operate in the derivatives markets, LBMA forwards and Comex futures, to manage the price of gold and silver. And I think we're starting to see a little bit of that now, mm-hmm. just from the trading patterns.
Well, it's interesting, again, you and I talked about this before we hit record today, that earlier this year, these, I guess, slams, for lack of a better word, as they're often referred to, kind of ended up changing from the New York Open to the London Open. And it seems now, especially, we're recording this on June 26th in the morning here. And today, as soon as New York opened, the price got, taken down fairly dramatically. So is there any indication or inference that we can take about that understanding?
Well, and that, on a lot of days, it's a pretty common pattern for, because if you watch, like investing.com, you got free access to real-time futures trading, mm-hmm. and you can run all kinds of time frames. So I run a 15-minute time frame, and I like to look to see what happened, what the trading was overnight when I get up in the morning. And it's very common for all of a sudden the price of gold to start declining going into 5 a.m. New York time. That coincides with the AM London price fix. And part of what enables them to do that is China closes, and basically all of Asia closes by 3 a.m. New York time. So any kind of physical demand that might be supporting the price of gold kind of goes away.
Mhm.
And so they can use, the Globex system to start pushing down the price, which is where Comex futures trade on a 23-hour a day basis, to push the price down and set a lower fix. And part of that is to deter technical trading, right? TA traders from piling into contracts if they see a bullish close on the fix. Because it's a lot of people aren't aware of this, but really the global price of gold that you see is keyed off of the AM and the PM London price fix. Because even though London's dominated by forwards trading, there's still physical gold that trades, and
Mhm.
it's been a piggy bank for the Eastern Hemisphere for the last few years. So, and then what happens is, whatever happens to the price happens to it. But then a lot of times it'll start to move higher after the AM fix. But then as soon as the Comex opens, which is 8:20 AM New York time, and sometimes the ball starts, they start rolling the ball downhill a little earlier than 8:20. But you'll see, I bet you 85-90% of the time, right at 8:20, boom, the price gets hit. And if it's not at 8:20, then it's 8:30 when there's economic report. Doesn't matter if the economic report is gold friendly or not, it just gets hit.
Mhm.
And that's not free market trading. So, and that's what we saw today. The price got pushed lower into the AM fix, got pushed down 27, about $12, and then it bounced back until the Comex opened, and then it got pushed down another over $20
Mhm.
from where it started to where where it bottomed out when the stock market opened. So that's been a consistent pattern for a long time.
Is it possible that we get, because of this Eastern pricing, taking over a decent amount of the market, or let's say the pricing power for the metals? Do you think that can help support the price of the metals going through the summer here?
I think it will. Yeah, I think it will. And that's actually a good point that you bring up, because I'm sure, as your audience knows, I'm sure they pay attention to this, or most of them. There's a price differential between where gold trades and silver on the Shanghai Gold Exchange and the Shanghai Future Exchange. There's a price differential between the price there and the price here, or what it would be referred to as the global or the world price of gold.
Mhm.
So, and kind of the world price of gold, for as long as I've been doing this, and probably longer, has really been set based on the London fix and then Comex futures trading. And so, but now what you're seeing is the real physical markets have moved east. I mean, the major physical hubs now, outside of London, are Dubai, Hong Kong, Shanghai, and now Singapore.
Mhm.
Singapore is moving into it, and it's becoming a major gold hub. And it hasn't been widely announced, but I actually have an article that I might discuss in my newsletter this week that talks about that. And so, to me, that kind of tells me that a truer price for where physical gold is trading globally is occurring in the Eastern Hemisphere markets, and specifically Shanghai Gold and Gold Exchange and Shanghai Futures Exchange. So, and I think, let me just see, there's a guy on Twitter who posts the numbers every day. It's awesome. It's at Oriental_Ghost.
Mhm.
And my buddy Chris Marcus has a rapport with him. But so, for instance, today at the Shanghai Gold Exchange, at what I guess you would call their price fix, their price close, silver was trading at $32.67 equivalent, versus here it's testing 29.
Mhm.
And then gold closed at 2,347.52. I'm sorry, that's the Shanghai Futures Exchange. Gold closed at 23.36 on the Shanghai Gold Exchange. So, you're talking that's, at that close, at the time when it closed, it was trading probably 10 or 15 bucks above the price that you might see on Kitco.
Mhm. And almost a 10% premium for silver.
Yeah. And so to me, that's the influence of the enormous physical demand that we're seeing from the Eastern Hemisphere. And I think what it's doing, and I think that's what we saw in that run up that led to successive record highs in gold and a breakout for silver, a breakout over the 28 and change level that everybody was watching. I think it was more like reverse gravity, where the price in the East was pulling up the derivatives driven market in the West. So, and again, I think because you'll start to see seasonal physical demand subside over the rest of this month and in July and probably into mid-August, we could see further weakness in the prices. But I really believe that we'll be at higher levels by the middle to end of the fourth quarter,
Mhm.
if not, the middle of the third quarter of this year.
So, Dave, what do you think explains the need, or let's say the positioning, to bring down the metals on days like today? Often we talk about incentives on the show. What do you think the incentives are to manage the prices of the metals?
Well, the banks that are the big players on the Comex, JP Morgan, Citigroup, um, uh, HG, whatever the heck it's called, HS, Hong Kong Shanghai Bank, I forget the ticker, HSBC, that's it.
Okay.
And there's a couple others. I think Goldman is in there, but they're not quite as big as like JP Morgan is the 600-pound gorilla. Citicorp, I guess B of A now is more active in silver. They make an enormous amount of money setting up big short positions. And then because the way it works, first of all, Comex is largely, I mean, there's floor trading, but there's all, it's for most of the 23-hour period, it's electronic trading. And hedge funds, algos, chase the price momentum, right? So when the price momentum starts accelerating to the upside, the hedge fund algos pile into that. The banks short contracts into them. They're paper, you print them up, or they're digital. You click of a keyboard and you've got a new Comex contract, and they feed that into the hedge funds. And then you reach like a technical point. Like I was staring at the charts of gold and silver probably 3 weeks ago or 2 weeks ago, and I'm like, man, this market is technically extremely overbought, and it's very vulnerable to a downside, a downside smack. And that's what we're getting. So what, and the hedge fund algos, a lot of them are keyed off of key technical levels and technical indicators. So the banks, what they do is they build up a large net short position, and then they start pushing the price down to trigger the technical, the sell stops that are based on technical levels. And then the hedge funds start to puke. So when you see Jim Sinclair would call them fishing lines. When you see a fishing line chart formation, uh, that's not all the banks. I think the banks get that process going, and then the hedge funds puke out their long positions, and that's what pushes the price down.
Mhm.
And the banks sit there and wait and start booking profits on the shorts they've set up at higher price levels. So I remember one year, I think it was 2012, maybe 2013. I don't remember the specific year, but it was around that time period. There was one quarter where all of JP Morgan's trading profits came from the precious metals desk.
That's crazy. That's a
Yeah.
crazy statistic to think about.
Yeah. I mean, it's not like that every quarter for them. I mean, they're making a fortune in trading bonds and equities, but in derivatives, over the counter derivatives. But so that's the motivation for the banks. And I think the banks are basically just given a green light from the central banks, on orders that come down from the BIS
Mhm.
to do what you can to manage the price of gold. And it's a profitable endeavor for the banks, or it has been, at least for as long as I've been doing this sector.
Is it possible, Dave, that we can understand more about, the positioning of the banks and then, as a consequence, the direction of price because of looking at the open interest or the positioning of the banks.
Much of the time, I think that, my business partner and I used to track, keep a spreadsheet where we tracked the weekly change in open interest for gold and silver going back to like 2006. And he passed, and I just don't have the time to do it. But you could kind of and he had a chart set up where you would correlate the level of net short position by the banks, the level of net long position by the managed money, which is primarily hedge funds and CTAs, and the price of gold. And there was a distinct correlation between a relatively high net short position by the banks, relatively high net long position by the hedge funds, and at some point within it wouldn't happen the next day, but you knew it was coming. There was going to be a price smash.
Mhm.
And it's pretty regular going all the way back to 2006. And again, I haven't looked at those numbers for quite some time, but I'm sure it's pretty consistent now. And you can tell when the open interest is starting to get high. It means the hedge funds are piling in to the long side, and banks are happily feeding them paper
Mhm.
or digital contracts. And you just know at some point there's going to be a price takedown operation. And similarly, when the open interest gets to a really low level, and sometimes the hedge funds actually, in the last few years, well, actually going further back than that, on occasion they get net short silver, and I think they've been net short gold once or twice, at least in the last 10 to 12 years. And the banks will often get net long paper silver, and I've seen them net long gold once or twice. And usually when that setup occurs, you're going to have a rally. And
Mhm.
again, it doesn't happen right away, but it's going to happen, and it's going to, the price is going to move higher. It doesn't tell you anything about timing or how, how significant the rally will be.
Right. So, Dave, when we try to put these pieces of the puzzle together with, you know, again, the incentives, you were explaining to me a situation that you saw in 2008 where, you know, a good amount of people understood that the banks were in trouble. It seems like we have, again, most people recognize there's a lot of different risks in the system currently, but how do we put that together with how the metals are being managed? And what did that situation in 2008 present itself as?
Sure. So I think, and I'm not the only one who's pointed this out, but there's quite a few parallels between what's going on in the financial system and the banking system and the economy now as there were in 2008, right? So, and back then, it it became obvious to me, and again, I'm not alone with this. It became obvious to me that, like in 2004, 2005, that there was going to be a problem in the housing market and specifically the mortgage market, but also just the banking system in general. And so back then, the price of gold ran up to a record high by mid March. I'll never forget it because, and silver didn't run up to a record high, but it ran up to its highest price since 1980.
Mhm.
And I was that's actually sitting in a condominium in Crested Butte, in the morning, getting, drinking my coffee, trying to decide when to go out and ski. And I was very actively trading futures back then. And I'm sitting there with my future software pulled up. And I think it was like, I want to say March 16th or something around that time. And I mean, gold's hitting record high. And then all of a sudden, boom, started getting slammed. And, that triggered a price decline. And I think it was primarily a manipulated price decline all the way through the summer. Obviously, there were rallies in between, but the price went from, don't hold me to this level, but I want to say it peaked either like at 1220 or around that, yeah, 1200 and change. And it ran all the way down to 700. And silver got banged from, I think it hit 21 at one point and got pushed all the way down to 7.
Mhm.
So, and that was by the end of October. Now, I think and you would think that, I mean, because everyone knew the banking system was in trouble. Bear Stearns had blown up. Rumors were rampant all summer that Lehman was going to blow up. And Lehman finally did blow up. I can't remember if it was September or early October that year, and Goldman almost blew up. It almost choked to death on OTC derivatives that it had pumped into AIG. And AIG was, as a counterparty, failed on those. So, but you would think that during that period of banking system and financial and economic turmoil, that the price of gold would be going higher, right?
Mhm.
Supposed to be a flight to safety. Well, no, it's getting pushed down. And I just have a feeling that, because we know the banks, especially the regional banks, are in trouble. And I know that the commercial real estate debt situation is worse than what's being presented by most analysts and in the media. There's so many buildings now that are getting sold privately at pennies on the dollar, and even visible transactions are occurring at 10, 20 cents on the dollar. And so that's a lot of debt that doesn't get monetized by selling the asset. That's a lot of debt that investors, whether it's commercial real estate trusts, bond trusts, or banks themselves that are sitting on those loans, they're choking on those.
Mhm.
And a lot of the probably the highest percentage of commercial real estate debt is held by regional banks, but the big banks in New York also own healthy slugs of commercial real estate debt. And what doesn't get talked about is, I can guarantee you there's also probably trillions in nominal value, face value, OTC derivatives that have been written, like credit default swaps and interest rate swaps. And so there's going to be an enormous amount of counterparty risk in the commercial real estate debt derivatives market. And again, that doesn't get talked about. And in 2010, they passed laws and accounting rules that made it easier for banks to move their derivative, to hide their derivative exposure off balance sheet. So we saw the regional bank crisis flare up in March of 2023. And immediately the Fed started printing money and pumping liquidity into the regional banks. And they had that bank term loan funding, whatever it was called.
BTFP.
Yeah, funding program. And that was in lieu of the discount window, because it's such a stigma to go take money at the discount window. But it's essentially another way of pumping reserves into the banking system.
Mhm.
And so I've also read some articles recently that suggest that the big banks are also starting to feel a lot of stress from the level of distress in consumer, corporate, and commercial real estate debt,
Mhm.
right? I mean, we know that auto loans and credit card loans, the delinquency rates and default rates are back to where they were in 2008, especially with subprime. And I have a feeling that the mortgage delinquency rates are higher than being advertised, but they're still moving up, and they're gonna get higher. So I think there's a ongoing deterioration in the quality of banks, regional and big Wall Street banks' balance sheets. And so, I think the Fed probably knows at some point it's going to have to start QE again. And whether that coincides with rate cuts or not, I don't know. But as we were talking before the show, there's already been a low grade level of QE going on, right? Well, let me share this screen. So this is the monetary base. It used to be called MZM. For some reason the Fed, well, I know why they do it. They're always tweaking how they measure the money supply and what they call it. So, but this is the base monetary supply, and it's bank reserves plus coin and currency in circulation. And you can see that it's been rising since February 2023. Well, yeah, that coincides with the regional bank crisis, but we were stabilized probably by here, and yet they kept pumping reserves into the banking system. Now, the way that I know that this is mostly a product of bank reserves increasing is you can go into this Fed website, the St. Louis Federal Reserve, and they show you what the actual coin and currency is in circulation. They segment these two numbers, and this monetary base is the combination of the two. So this is mostly bank reserves, right? And this is the most powerful form of money supply because it's instantaneously available, right? I mean, you got coin and currency in your pocket, you can spend it. You don't have to take out your credit card and run it through a scanner to get charged. And bank reserves, which they can leverage up. So, this increase in the monetary base, it might not look like that significant on the surface. I mean, at one point it was up 600 billion, but the banks can leverage that because,
Right.
And there's not even a reserve ratio requirement anymore. They removed that during the COVID period. So this is a very powerful form of money supply. And I think and we talked about M2 also, and I don't have that chart handy, but I showed it to you, and it's been rising since October 2023. Now, if the Fed is trying to fight inflation, why is it? And there's another point I'll circle back to. Why are they letting the money supply rise, both the monetary base M1 and M2? Why are they letting the money? This basically tells you they're pumping reserves into the banking system, and it's therefore a low grade form of QE. I mean, they're not out there buying treasuries to inject reserves into the system, but they're creating reserves. Now, why are they doing that if they're trying to fight inflation? Now, you're probably aware of this, as is your audience. About 3 or 4 FOMC meetings ago, the Fed removed there was a line. I think it started off the second paragraph of the policy statement. The banking system is sound and healthy, or whatever it was. That's a paraphrase of what it was. But 3 or 4 meetings ago, they removed that line from the FOMC policy statement.
Oh, interesting.
Yeah. Now, why would they do that if the banking system is still strong and resilient? That's what they said. That was the phrase. The banking system is strong and resilient. Why would they remove that? And at the same time, as I just showed graphically, they're increasing the level of bank reserves. They're letting the money supply creep up. Why are they doing that if they're trying to fight inflation? I mean, they've got everyone brainwashed. Well, not everyone, but they got a lot of people brainwashed into thinking that they can control price inflation with interest rates. Oh, well, we're just going to kill demand. Well, yeah, they've killed demand because people can't afford to borrow to fuel their consumption anymore. But it hasn't helped prices.
Well, I think that really speaks towards the easing of financial conditions by the market, right? It's not necessarily the Fed that has perfect control of that. And as we talked about earlier, financial conditions themselves have almost never been easier, yet we're at 5.25%, 5.5% overnight rate that's driven by the Fed. So it's, there's always this, I think, tug of war that it gets talked about, if the Fed really has control over inflation and financial conditions and, interest rates, and or how much control it actually has. And I think the market, because of liquidity, because of money supply, is able to sustain and have much easier financial conditions despite this higher interest rate, right?
I agree with that, and believe me, I have the utmost respect for the bond vigilantes. I mean, they were around, but I think they started in the 80s, maybe, I forget, but they were pretty prominent in leading the Fed into interest rate cuts and hikes back in the 1990s when I was trading junk bonds in New York on a trading desk. And so, yeah, what the bond vigilantes are telling you is that the economy sucks. we need lower rates to stimulate the economy. And if the Fed were to do that, it would be seen as giving up its fight on price inflation, because price inflation isn't subsiding. I don't care what the month-to-month CPI report says. There was a great article that was posted on Zero Hedge just this morning, and I think it's called From the Rutherford Institute or something. And they go in there and they just dissect exactly what's wrong with the CPI report and why it doesn't measure the true price of inflation. Everyone should read that article. It's whether you like Zero Hedge or Hedge article, it's one of the people that they post, and it has a lot of merit. I might even post it on my blog because I was really impressed with it. But
we'll try to post the link in the show notes.
The level of real price inflation is much higher than what the CPI is showing, and the Fed knows that. Mm-hmm. So they have to kind of hold interest rates at this level, even though and they know the economy stinks. They get better. Their research department has better access to all the economic and financial system data than anyone in the world has. So they know. But they have to be seen as being tough on interest rates, because that's how they're going to fight inflation, right? And if they start cutting rates, the dollar's going to, it's going to do a fishing line chart, and it's going to make it even worse to fund the deficit, the spending deficit. It's going to cause all kinds of new problems that the Fed doesn't want to deal with right now. So, and going back to the financial conditions, I mean, there's more to that than just the level of interest rates and the level of bond spreads between treasuries and corporates and investment grade corporates and high yield. And those spreads are historically tight right now. So that's part of what goes into, I saw a chart, I think it was yesterday, the easiest financial conditions, the way they measure it, going back to early 2021. As bank lending to the subprime sector has tightened down, but if you're a prime grade borrower, it's not that hard to get a bank loan. It's more expensive. But what else is affecting that? I mean, all you have to do to get a buy now, pay later loan is fog a mirror. And that's kind of, there was a big article that was posted on Bloomberg News, I don't know, probably 2 or 3 months ago. I wrote about it in my short sellers journal. And it was talking about how some buy now, pay later companies are experiencing 43% delinquency in their loans. Yeah. And the research outfit that put together all the data for Bloomberg, went out and interviewed buy now, pay later users. And, most of them, not most of them, but a large percentage of them were tapping into buy now, pay later because their credit cards were maxed out already. And they're behind on their auto loans. So, and they're using the buy now, pay later loans to fund non-discretionary expenses or take trips or whatever. And so that also feeds into, part of the reason why the financial conditions are so easy. I mean, even if you have a crappy credit rating, you can still get a buy loan, 4%. But if you pay certain, I think they give you a 3 or 4 month period to pay it off, and you don't get charged interest.
Is it possible that we see, some of these data points are actually revealing the fact that there's much more of a bifurcation of the US population at this point, meaning, there's more rich and, let's say, more poor, but the middle class is just being, put into one of those two categories, where we're seeing, a little bit of increase or high levels of travel. However, also high levels at the same time of these buy now, pay later loans.
I would suspect that, there's definitely a bifurcation between the haves and the have-nots, and the percentage of the have-nots has gotten very large. So, I mean, I think my guess is that the record level of travel expenditures that we're seeing this year, it's probably coming from the top 10%, the top 5% of the income and wealth demographic. Because, and again, I research these numbers weekly for my short sellers newsletter. crap, I can't remember what the exact percentage is off the top of my head, but it's something like 65% of middle class households surveyed have trouble making ends meet every month, and they've tapped out of their savings. So when you see the mainstream financial media pumping the savings rate numbers or the level of savings, most of that is the upper 1%, because most people, and there's actually been a lot of work published on this recently, because remember, the savings rate soared during COVID because the government was handing out, multi-$1,000 checks to most people. And so the savings rate went up. And also there were credit card payment and auto loan payment moratoriums. And then there was rent moratoriums. So people didn't have to spend money on rent. They were saving it or taking, they basically spent it. But now in the last, I want to say 6 to 9 months, there's been some work published that shows that excess savings is gone. So, yeah, I mean, I would say that at least 75 to 80% of this country is feeling some form of recession, and probably the bottom 50% would tell you that we're in a serious recession right now.
We just don't
they're
have
having trouble. They're having trouble paying their expenses, and I've even seen surveys where there's a certain percentage of families that aren't living in welfare poverty levels that worry about putting food on the table for their family.
Yeah, I spoke about this with Danielle DiMartino Booth the other day.
Okay.
And her instinct is that the recession is already here. A lot of people feel that, yet it just hasn't been confirmed by the data yet. And this is always, a backwards looking type of acknowledgement, right?
Well, and also, and this article that was posted today on Zero Hedge talks about this, and it's something that I've been pointing out in my newsletter for quite some time. When you look at like industrial production numbers or retail sales numbers, all these macro reports that measure the level of factory manufacturing, industrial production, whatever, fill in the blank. They're all expressed in dollars, nominal dollars. And so when you've got the rate of inflation that we have in this country, it's going to show growth in those numbers. But when you start adjusting those numbers for just even CPI inflation, it removes all that growth. And they have charts in that article that illustrate that. And it's just like retail sales. They say, oh, well, retail sales increased 0.3% in May versus April. That wasn't the number, but as an example. Well, if you look at what the CPI was in May, and you discount the headline retail sales number by the inflation rate, you're no growth or you're negative. And on a year-over-year basis, you're definitely negative. And then if you go and use a real inflation measure, like the John Williams Shadow Statistics Alternative Measure, and all he does is he measures price inflation the way the government calculated it in 1990 and in 1980. Now, 1980 is when they started tweaking the index. And again, this article discusses where and how they tweak the index to mute the real true price inflation. But just the 1990 version, and they had already been tweaking the CPI for 10 years by 1990. I looked at it the other day. I think the 1990 CPI would show you that inflation is more like 8%. So you take a year-over-year retail sales number that might be showing 2 or 3% year-over-year nominal growth, and all of a sudden you're a negative 6% just by the 1990 calculus. The 1980 calculus, the CPI calculus, shows inflation more like, I don't know, I looked at it the other day and I can't recall specifically. It's like 12 or 13%, which is probably what most people are experiencing now. It's not just groceries. It's all other household expenses that don't get picked up by the CPI, or like health insurance. They completely turned how they calculate the cost of health insurance upside down on its head, and they don't measure the cost of price insurance. They use the retained earnings of the companies that sell health insurance as their measure. The change in retained earnings as their measure of what health insurance inflation is. Well, I've got a subscriber who sells corporate group medical policies, and the first time that they showed the cost of health insurance, down on a month-to-month basis, he said, "No, year-over-year health insurance is up 30%." But the CPI doesn't pick that up.
And I mean, in the US, that can be a giant percentage, especially of let's say, a lower to mid income level household. Medical expenses, I believe I read an article that said that they're the number one cause of bankruptcies in the US, right?
Yeah, absolutely. So yeah, I mean, just to kind of circle back, I would say, a good 75 to 80% of this country, maybe even more, is feeling some form of, economic hardship and economic contraction. It gets worse as you go down lower on the income and wealth demographic scale. And ultimately, at the end of the day, elections, assuming they're clean, are basically, primarily decided by whether the economy is good or bad, right? I mean, George Herbert Bush, he got voted out because the economy sucked in '92 when that election was held. Um, I mean, I think the country was going to vote in a Democrat anyway in 2008, but obviously, you had complete economic and financial turmoil back then, and you had a changing of the party leadership in DC. And if you look at the legitimate poll numbers now, I mean, Trump is killing Biden, and I don't have a dog in the hunt. I haven't voted since 1992, so and I don't think we have a good choice. Period. But the polls are telling us that to me, they're reflecting the fact that a large portion of this country, first and foremost, is being affected by a bad economy, despite what we're being told by the Democrats, the Biden administration, and the mainstream media. And then there's all these other issues in there, like the immigration, the illegal immigration and all that. Those are secondary to the economy at the end of the day when it comes to elections.
Yeah, absolutely. I mean, obviously it all adds up, but unfortunately, these elections do become very single issue type votes, right?
Right, the economy.
Yeah.
It's the famous line that James Carville put out there, and he was Clinton's political strategist, and people would ask him why is Clinton leading in the polls, and he said it's the economy, stupid. And so that kind of became a catchphrase that stuck with me for a long time. So and I would say, yeah, you've got the Middle East situation, you've got the Ukraine situation, you've got the border situation. Those are all influential factors. And certainly, I think for the younger demographic that will vote, they seem to be a lot more impassioned about what's going on in the Middle East than the baby boomers do. And everyone has their own opinion there, but I would say the number one factor is the economy, and the poll numbers reflect the real state of the economy and the real financial condition of the average household.
Mm-hmm. So, Dave, I want to also get your thoughts on what this current situation, what this current financial landscape means for mining companies as well. It seems like in some circles, there isn't enough capital to go around to necessarily even, make ends meet. Therefore, it makes me wonder if this is also possibly a factor right now for mining companies. Are they having trouble getting financing? Are they having trouble operating? What is your feeling within in the mining sector?
Sure. Again, that's a good question. Again, you got to segment the mining companies into the producers and the junior project development companies. So the producers, the well-run producers, they're printing money right now because the spread between the prices of gold and silver and their costs the spread has widened quite a bit. We went through a period there where the costs started creeping up to, the cost per ounce started creeping up to the price per ounce that they were receiving. Well, in the last, call it two to three quarters, that spread has widened considerably. And the well-run mining companies, like I said, they're literal monetary printing presses. So I mean, I was looking. I don't advocate investing in Barrick, and I don't own Barrick, but I was looking at its numbers the other day because it's involved with one of my junior microcap companies, and I mean they've got close to $4 billion in cash on their balance sheet. They don't need to worry about financing. I think what we're going to start to see, assuming the price of gold and silver stay in this range or move higher, I think in the next 12 to 18 months, we're going to start seeing a lot of M&A activity as these larger, as the producers look to buy reserves in order to replace what they deplete. Now, the junior micro caps, it's kind of feast or famine. Some of them that I follow are not having a problem raising money, and there's pools of capital out there that are available to invest in these things. I mean, we just saw, what was it, about 4 or 5 months ago, Paul Singer, the investment / hedge fund manager. He's a zillionaire. I always forget the name of his fund or his firm, but he announced that he was establishing $1 billion fund to invest in mining stocks, or mining projects or individual mines. Mm-hmm. So, and then Stanley Druckenmiller, who's, I'm sure everyone knows who he is and what his background is. He also announced, has been very vocal about the fact that he's buying Barrick and Newmont and some other ultra, the largest cap mining stocks. And I wouldn't necessarily recommend those either, other than Agnico Eagle maybe, or Goldfields is among the largest. But he, to invest the kind of money that he's investing, he wants liquidity, and you're still going to get the leverage effect with Barrick and Newmont to the prices of gold and silver. If you think gold and silver are going higher, you'll still get the leverage effect of investing in those mining stocks. I just happen to think they'll underperform, their smaller cap brethren. So I guess my point here is that, so there's another mining company that I'm involved in that's trying to do a raise, and its existing investors have committed to fund 50% of it, but the CEO's out, traveling around the globe presenting the story to try and raise the rest of it. So, but I guess my point is that there's still for good stories out there in the project development mining stock land. There's still capital that will invest in these things.
Mm-hmm. But, do you see a catalyst maybe on the horizon at some point that brings more of this capital into that space? Because, even though we've seen some encouraging signs, it's not like we've seen any type of a dramatic shift into, GDX or GDXJ, any of these sectors that matches, I would say, that is proportional to what one would expect for this price rise of the underlying metals.
That's also a really, really good question. It's also something, believe it or not, that I've been contemplating for the past few months. Mm-hmm. And what I've discussed in my mining stock newsletter is that, well, the hardcore, the core precious metals investors, they're always there, right? Mm-hmm. And some of them made the mistake of being fully invested for the last 5 years, and some of them, they have cash for when they think the market feels better, and that's mostly the retail base. But there's also smaller institutional fund complexes that have mining stock funds that they offer, and those are to some extent dependent on, obviously, investor inflows and outflows. But then there's private equity funds are also, you're starting to see private equity funds take some of their cash that it's kind of the Silicon Valley phase of the financial bubbles kind of passed. So, and they need places to invest. And to me, the precious metal sector is pretty obvious. So you're seeing that. And there's other pools of wealth and capital out there that are always going to look at investing in the sector. But I think to your question, what's the catalyst that's going to trigger a major stampede into the sector? And I think we got to wait until the stock market rolls over and they pull the rug out from underneath all these incredibly overvalued tech stocks, because that's what's got the focus of the majority of market participants, right? I mean, hedge funds and other investment managers, they're piling into the Mag 7. Why are they piling into the Mag 7? Because everyone else is, and for them they have to at least match the performance of their peers to get paid, right? So rallies like we're seeing now become self-fulfilling prophecies, because it's, everyone has to pile into these things to keep up with their peers. And you're actually seeing that in the breadth numbers in the stock market. I mean, it's the Mag 7, and really specifically three stocks, NVIDIA, Apple, and Microsoft, are responsible for most of the gain that we've seen in the broad indices year to date. In fact,
somebody said the other day, Dave, the Mag 7 has now become the Final Four.
That could be. You mean with Meta?
Oh yeah,
Meta,
could be
Apple, Microsoft, and NVIDIA.
Mm-hmm.
I think Meta is, yeah. But and actually, I did see a chart that showed, like, year to date, the Mag 7 was almost all of the returns in, I think it was I can't remember if it was the NASDAQ 100 or the S&P. And then the other components were flat on the year. So 400, it was the S&P. So it was seven stocks are responsible for the entire gain in the S&P. The rest of the stocks collectively are flat, 493. So I think once the Mag 7, and eventually it'll happen. I don't know what'll trigger it. Maybe a bank crisis. I don't know.
Mm-hmm.
I think once you see that, when these guys can no longer, when they have to pull money out of these stocks quickly, I think you'll start to see some of that money move into the sector, the precious metal sector. And it doesn't take a lot. And that's what we saw in 2008. I mean, back then, Fidelity's had macro funds that were starting to put a lot of money into the mining stocks. Mm-hmm. And some of their funds were actually taking big positions in the junior microcaps, because they have to take big positions in order for a single junior microcap investment to have any material effect on their rate of return, right? Because these funds are big. I mean, the junior microcaps that I look at are anywhere from, $6 million in market cap to 100 million in market cap. So, Fidelity's got multi-billion-dollar hedge funds, or not hedge funds, but investment funds. So, but so we saw that starting in 2008, you started to see generalist funds and retail move a lot of capital into the sector. And like I said, on a relative basis, it doesn't take a lot of capital to move the needle on the mining stocks. And so when this stock market rolls over, they pull the rug out from under the Mag 7. I think that'll be the catalyst that'll really jettison the mining stocks.
Mm-hmm. Well, time will tell, unfortunately, right?
Oh, it will.
Well, Dave, I appreciate your time and sharing your perspective with us today. Is there anything else that you'd like to share with our listeners or leave them to think about before we wrap up?
I mean, I would just say, for the ones in your audience who are avid precious metal sector investors, don't get discouraged by what you're seeing, over the last, I guess, really since the latter part of May through now. And we might even move lower, going into July and early August. But I truly believe, again, I think the precious metal sector is bouncing back and behaving with more vibrancy now than it was in the summer of 2008. And I think a big catalyst there is just the enormous amount of physical demand that's been occurring over the last couple of years from the Eastern Hemisphere and Eastern Hemisphere central banks.
Mhm.
So, and I think we're at the point now where the prices in the physical market and the level of demand is going to make it harder for the Western banks to, operate their in price management mode. And so I think between now and the end of the year, we should be definitely higher, if not considerably higher, in the prices of gold and silver. And a lot of that will be driven by India coming back in a big way in the early fall through the end of the year. And I also think that we'll get a nice boost, assuming the prices of gold and silver move higher, like I think they will, at some point later this summer. I think we'll start to see a really strong rally in the mining stocks. I mean, we had a strong rally in the spring in the mining stocks, and people were still whining to me, how come the mining stocks aren't doing better? I'm like, well, wait a minute. GDX was up like something like 25% in a 30-day period. Those aren't the exact numbers, but it was something similar. What more do you want? That's better than the NASDAQ.
Yeah, I mean,
I think we're headed in that direction.
and it's always interesting to see that contrast. It always seems like it's never enough, but you see that contrast compared to these other indexes. It's a completely different situation.
Yeah.
Excellent. So for those that want to see more or read more from Dave, always available at investmentresearchdynamics.com, and a great Twitter follow as well at INVRES Dynamics. Dave, thanks so much for your time today.
Thank you, Tom. Good chatting with you.
Always.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.